Assalamualaikum and hi. Let me introduce myself. My name is Mira Nur binti Muhammad Kamrul. Today, I want to present about capital structure. Introduction. A company's capital structure refers to its particular mix of debt and equity. The equity represents more permanent and flexible investment, but debt is legally obligated to make fixed payment schedules to refinance future debt. A company's optimal capital structure cannot be without debt. To achieve debt, borrowing must be cost-effective relative to equity and financial distress costs. Capital structure is influenced by business characteristics, capital structure policy, and leverage target and market conditions. What is capital structure? It's operation and growth, which is combination of debt and equity. Stock, preferred stock, and retained earnings are examples of equity, while bonds represent debt. There are several types of capital structure for companies, including long-term debt, short-term debt, common stock, and preferred stock. Each likely analyzed are referring to a firm's debt to equity. How likely a company is to borrow money in the future. Investing in the capital markets requires a company to raise money through debt. It may be tax deductible to make interest payment on loans made to company because of debt advantages. How to determine optimal capital structure. WACC, cost of debt and cost of equity all contribute to the optimal capital structure of a company to consider the cost of capital. To maximize a company's market value, capital structures need to minimize costs. It is imperative to consider the trade-offs the company faces when deciding the optimal capital structure. Due to this, investors will be seeking higher return. Factor affect capital structure and capital structure decision. Cost of capital. Fundraising costs are determined by the expected return on supplier investment. Control. Fundraising through equity share is not suitable for management who wish to limit outside interference in their operation. Earnings. Debt can be used by companies with relatively stable revenue to finance their capital structures. Tax policy. Debt and equity instruments are also crucially taxed by the government according to its monetary policy. Size of the business. Financing is influenced by its size and scale. The ability to raise long-term borrowings. Stage of the life cycle. They would be better off using a much higher percentage of ordinary share capital. Financial distress. Financial distress occurs when a business or individual cannot meet or pay its debt obligation due to insufficient revenue or income. The consequence of ignoring this warning sign can be devastating. It may be necessary to file bankruptcy. Unable to meet their obligation by their due dates. An example of an expense a firm must pay its interest on its debt, opportunity cost for projects and non-productive employees. Cash flow statement that show negative cash flow usually sign of financial distress. Cash payment and receivable being out of balance, high interest payment might be causing this. It is common for people experiencing financial hardship to find that their debt service costs exceed their monthly income. Integration of tax effects and financial cost distress. The tax effect and financial distress costs related to the value of the firm tend to increase the stake as debt moves from equity to debt. Small distress actually comes from small amounts of the present value of distress costs. There is a trade between the tax advantage of debt and the cost of the financial distress. The value of the variable interest tax shield means borrower cannot borrow an unlimited amount because it will lead to bankruptcy. When the value of the cost increases, the represented value of the cost will increase. It will eventually match the growth in the present value of the tax shield. Bankruptcy will increase quickly as a result of the tax shield lowering their firm growth. Agency cost of equity. Companies managers to run it in a way that maximizes shareholders' profit Managers seek to maximize wealth. A conflict of interest between management and shareholders. Shareholders perceive a consequence of management making unwise decisions to not increase the values of their shares. For example, much will be benefit the business, but shareholders believe the much will not benefit the business. Pecking order theory. Asymmetric information is basis of pecking order theory. As known, information failure occurs when one party has more and better information than the other about the company's performance, prospects, risks, and future outlook than other external users, such as creditors and shareholders. Retained earnings financing minimize information asymmetry by originating directly from the company. Signaling hypothesis. Choose capital structure based on inside knowledge, signaling market information. It about future earnings may will influence leverage if debt increase are considered positive sign. Interest payments have priority over dividends because interest payment represent an obligation. The financial structure announcement affect share price more than bonds price. The signaling theory is empirically tested and new equity offerings are found to reduce share price by 3% on average. As a result of that issue announcement, share price declined only slightly. The end. Thank you from me. Assalamualaikum.